Want to retire with way more super without working longer or sacrificing your lifestyle? These 5 superannuation hacks can help you boost your retirement savings by tens or even hundreds of thousands of dollars. And the craziest part? Most Australians aren't even using them. Today, we'll break down these simple strategies, how they work, and how much they could add to your nest egg, and why they're so important to execute. Now, the first hack I want to talk about is called salary sacrificing. So what does this mean? As we've covered in previous videos, there are 2 types of contributions that you can make to superannuation: concessional and non-concessional. Concessional are tax deductible and limited to $30,000 per person per year. Non-concessional are not deductible and limited to $120,000 per person per year. Now, concessional contributions are made up of super guarantees, so the ones that your employer has to make, as well as salary sacrifice and after tax or from your savings concessional contributions. So what's the benefit of a salary sacrificing arrangement? Salary sacrificing allows you to direct more of your pre-tax income, so before your employer pays the tax to the Australian Tax Office, and divert that from your personal income into your super fund. What does this mean? It means you don't pay tax at your marginal rate, which in 2025 is 16, 30, 37 or 45%. Rather, that income is diverted to superannuation and you pay tax at a 15% rate on the contributions. Therefore, if you think you made a $10,000 additional salary sacrifice contribution over a financial year, and you're on the top marginal tax rate of 45%, you're likely to save, and you have the potential to save $3,000 per year in tax. Even better is the fact that this money is then going into the more tax-effective superannuation environment. One of the keys here, however, is that salary sacrifice agreements have to be forward-looking. You can't suddenly decide to make an extra salary sacrifice contribution from your salary at the end of the year. The big benefit here, and I think an additional benefit as well as tax, is that you're setting yourself up into a forced saving strategy. That is, you're putting more money into a low tax environment and giving it the ability to compound. If you're able to put an extra $50 per week as a 40-year-old and invest that for 20 years, your balance will increase to $164,000 based on an average market return of about 10%. The next hack I want to talk about is the government co-contribution, and I call this one free money. Every dollar counts when you're looking to self-fund your retirement, like the clients I work with. This one is for low-income earners, but in many cases it works for one member of a couple when they're earning less than their spouse, which is incredibly common. Essentially, you can get a free $500 if you make an extra contribution to superannuation. That could be a really, really nice dinner in retirement, or domestic plane flights, or anything, and every dollar counts. How do you get this? You need to make a non-concessional contribution from your savings or bank account, and thus you need to be eligible to do so. So meet the normal contribution eligibility requirements. The person making the contribution to receive the co-contribution from the government, your income must be less than $47,488 in the current financial year to get that full $500, or less than $62,488 to get a portion of that, and it reduces for every dollar that your income is above that $47,000 up to $62,000. And another eligibility requirement is that you do need to be producing at least 10% of your income from employment or carrying on a business, whether that's a sole trader or something similar. So you will have to do a little bit of work to be able to obtain this, and you have to be under 71 years of age. To get the payment made, you need to lodge a tax return as you normally would. This is usually paid between November and January each year. The third hack I want to talk about is spouse contributions and contribution splitting. Now, it's common and incredibly common for there to be uneven balances between spouses, and something we tend to do with our self-funded retiree clients is maximize and try to equalize the balance between the two to use up both of those $2 million caps. In this case, contributing on behalf of another partner is an incredibly attractive strategy, and there's different ways to do this. You can either split some of the contributions you've already made as the larger income earner, or you can contribute directly into their fund. Now, let's start with the latter. You might be able to actually get a tax offset that just reduces the taxes payable by contributing for your spouse. This works similarly to the co-contribution. You need to make a non-concessional contribution on behalf of your spouse. To do so, you both must be residents, and your spouse's income must be less than $40,000. That's their assessable income for the year. In order to make those contributions, you naturally need to be under the non-concessional contribution and the total super balance cap being $2 million and $120,000, and you need to be under 75 years of age. So once your income hits $37,000, your $540 offset starts to reduce, and it is calculated as 18% of $3,000 minus the amount of income over $37,000, cutting out at $40,000. The second part of this hack is called contribution splitting. Splitting contributions allows you to split the amounts you've already made into your spouse's account. Now, you need to apply with your super fund to do this for you. It's not something you can do yourself. It is treated as a rollover, not a new contribution. Under the law, you can split as much as 85% of your concessional contributions you make in a year. There could be super guarantee, salary sacrifice, as we mentioned before, and even unused carry forward contributions. 85% being the total contribution less contribution tax, which is then split, so it doesn't reduce in any way. The key here is that your spouse must be under 65 and not retired to split into their name. You can still get the tax deduction in your own name, and you should always lodge a notice of intent to claim that contribution before you're making a contribution splitting request. This is key. You need to lodge this quite quickly after the end of the financial year to have your super fund process it, particularly if you're an industry fund. And this is an incredibly good option if you're seeking to manage gender gaps or different balances between your accounts. It can also help in adjusting your balances to maximize the age pension if one partner has reached 67 years of age already. And the next hack I want to talk about is huge. It's called Catch Up Unused Concessional Contributions. This is a little known hack that allows you to use the contributions caps you've missed in prior years. It could have been because you weren't working, you didn't have enough cash available. This one is great for self-employed people with lumpy income and those returning to work and those self-funded retirees. It can even be used to help reduce capital gains tax on business sales or investment property sales. If you don't use your $30,000 or previously $27,500 contribution cap, fully use that in the last 5 financial years, they may still be available to you. You just need to go onto MyGov and check under superannuation to find out if you have any leftover cap there. So what you can do is bring forward up to 5 years worth on the single proviso that your superannuation balance 1 July the prior year, so you need to recalculate this now, was under $500,000. And this is across all superannuation funds, so not just one or the other. The key here is that once you've made these bring forward contributions, you can actually split them with your spouse as well under the contribution splitting section we talked about earlier. So let's say that $50,000 is available and you have a $100,000 capital gain from an investment property sale. Your deduction will reduce this capital gain and potentially save you over $20,000 in tax. But the key here is always pays to keep evidence. So take a photo of your concessional contribution cap before you make it and make sure you've got the evidence to support that, just in case the calculation wasn't accurate at the time you made it. Final hack I want to talk about is us turning to investments and getting the most out of your superannuation. Now the key here is about choosing the right fund and fees. A lot of conversation, a lot of focus is on fees or investment returns, but both matter. This isn't to say that one fund is better than all the other funds for everyone. There is a different super fund that's suited to each person depending on what you want. The fees and performance can cost you hundreds of thousands of dollars over the years. Both are just important. And my advice here is don't just seek the cheapest, as that doesn't always work out. What we've seen in recent years is a growing divergence on a year-to-year basis between the best and the worst funds, with the top fund last year sometimes falling to 20th fund the following year. Superannuation funds are taking more and more risk for their younger members, particularly the larger superannuation accounts, which means they're not always suitable for retirees. Let's think about this, what the impact of an additional 1% in returns could be. So if you have $1 million at retirement and you're compounding this at 7%, this has the potential to grow before we talk about taking pensions from it to over $4 million. But if that return was only 6%, the balance is $800,000 less at about $3.2 to $3.3 million. That's a nearly 25% difference. The key here is that you could apply the same rule when it comes to a 1% fee reducing the return that you have. Both performance and fees matter, and retirement demands consistent as opposed to volatile performance. When it comes to Waddle, that's why we prefer blending both active and passive investments, not just going for the cheapest, but paying for what you get in terms of quality professional management that helps navigate through periods of volatility and challenges. Not all active, unlisted, expensive investments are actually going to outperform. We're seeing that more and more from the industry super fund sector at the moment. But what we're talking about is making sure you're getting your strategy, your investments, your fees right for you, not just for right now, but for the next 10, 20, and 30 years. Now, my last little bonus tip is check your investment option. Most people leave their super fund in balance without understanding what that means, or they switch to low risk when the market falls. Small tweaks in asset allocation early on in your retirement can make a huge long-term difference. So just want to go back through those quickly again. The first hack we've got is salary sacrificing. The second, using the government co-contribution or free money. The next is using spouse contributions or contribution splitting, your unused carry forward concessional contributions, and then getting the most out of your superannuation. Thank you for watching. Please give us a like and please reach out if you're looking for advice as a self-funded retiree.